Hi YouTube. Last week we went through a short video on calculating your possible returns from silver, and this week I'd like to do a continuation video of that. And in this presentation I'd like to show you comparatively the possible returns from both silver and gold. As you see from the top, I've actually updated the data here for the most current spot prices for silver and gold. So these are the spot prices. Um, I've placed margin percentages here based on uh, what the bullion dealers here in Singapore would make. This figure is for a 1 ounce silver bar, and this one is for a 1 ounce gold bar. Um, Given that margin, this is what you would need to pay in terms of a retail price for gold and silver. And then I compute a percentage increase here based on the target prices, the average price of silver for 2011 and the average price of gold in 2011. Okay, so for silver, to reach 2011 prices, the price would need to go up 140% from the current spot price. And then for silver to reach 2011 prices, it would need to go up 41, almost 42% from the current spot price. Okay, given that, and the bullion dealers will again take a cut when you decide to sell back to the bullion store. These are your net amounts, and these are the percentage of profits you made from that sale. So if we base it on the average price of 2011, which is more or less the highest price of silver and gold, we see that silver has a long way to go with 140%. It can go up to 140%. And on the other hand, gold can run up to about 42% before it hits the same 2011 rate. Okay, so if it were to hit those 2011 prices, you might make 81%, around 81% for silver and 31% for gold. Okay, how can you actually increase those profit levels if you can buy from people and therefore decrease the margins that you need to pay, the premiums you need to pay? If you decrease the margins here, then you'd increase your net profits. Or when you're selling, if you are able to sell to a store with a lower spread, then you'd again be able to increase your profit. Okay, so I'll go now to a sheet that shows you different scenarios for gold. Okay, so in these different scenarios, I'm going through a possible scenario where, let's say, gold drops 20% more. I would incur a negative 26% loss. Negative 10%, a 10% decrease in the price would hit me for negative 16% loss. A 10% increase in the gold price would give me around 2% profit. A 20% increase in the spot price would result in about an 11% profit for me. 30% would result in a 20% profit. And if I hit the maximum of 41 or 42% price increase, I would be able to walk away with a 31% profit from my gold item. Okay, moving on to silver. We see that actually you would take on a bigger loss, you know, from uh, for you to actually make money. or at least break even from a silver investment, you would need to make somewhere around 32%, 33% increase in the spot price for you to be able to break even. And at 40% spot price increase, you would be able to make 5%, around 6%. And if the spot price were to increase 140% or goes to the average about $35.23, you would stand to make 82% profit for your silver investment. This means that basically you do have a higher potential for silver, higher profit potential for silver, but also you need to understand that it works both ways. If the market does go bad, you also need to understand that you are taking on a higher loss. These are because of the margins that the higher margins that you are paying for when you are investing in silver. Right. I hope that helps everyone who is currently invested in gold and silver. I hope this video helps to give you a more informed decision on how to go about your precious metals investing. That's all, YouTube. Thanks for watching. See you next week. Bye.